Okay, let's take a look at an exercise that teaches us how to post to T accounts. So we want to understand that when we're posting to T accounts, there's a very different meaning than if we were to do posting using journal entries, right? So posting to using a journal entry means that when we post that transaction, whatever it is we record, those are going to impact the accounting records, right? So journal entries are very, very serious matters. T accounts, on the other hand, when we post to a T account, what we're attempting to do is we're trying to reconcile an account balance, an individual account balance. And so when we post to a T account, the term post can be a bit misleading. These figures do not appear anywhere in the accounting records. So where does the name T account come from? It comes from this little shape here. We have different accounts, cash, inventory, accounts receivable, and so forth. And if we take this part here and then we take this little dividing line here, we form the letter T. And so what's that dividing line for? Well, the left side is our debit and the right side is our credit. Right? And so I'm just going to do that for the first one, so we kind of have an idea of what it is we're doing here. All right, so looks like we have some transactions A through F, and yeah, let's see here now. Okay, so we'll look at the very first one under A. We're going to receive merchandise inventory costing $9,000, and we're going to purchase it with cash. Okay, so we don't have a beginning balance for cash. So hopefully we had some cash as a beginning balance, but I don't have that information available to me. So I'm just going to take this transaction and record it. So inventory is an asset, and assets go up on the left. So I'm going to go over here under A, and I'm going to write down $9,000 under inventory. Cash is also an asset, but it has gone down. So watch what I'm going to do. I'm going to record this $9,000 here over on the right side to indicate that this asset has gone down by $9,000. This asset inventory has gone up by $9,000. Okay, B says sell half of the inventory in A for $7,500 on credit. Okay, so a lot of stuff going on here. A lot of stuff going on. So let's look at the first word. It says to sell. All right. So we sold inventory for $7,500. Now sales revenue has a normal credit balance. So let's go to B and write $7,500. We also sold that inventory on credit. So this produces an asset called accounts receivable. And so let's go over here on the left side, because accounts receivable is an asset. It goes up on the left. So that takes care of the sales transaction from a revenue standpoint and the resulting asset. However, we also have to understand that we don't have part of our inventory that we had before. And so now we're going to have to expense that. So let's think about this. Probably need to bring up a calculator. Make that a little smaller and then drag it over here. So it says that we sold half the inventory. So full amount is $9,000. So if we take half of that, or 0.5, we get $4,500, right? So also in B, we have to do two other things. We have to reduce inventory by $4,500. So let's do that. But notice we're going to do that over on the right side, not on the left. Here inventory went up by $9,000. Now it's going down by $4,500. Well, what went up? An expense called cost of goods sold. Right? So there it is right there. So we did four things on B. Let's move this calculator out of the way. We might not need it again. C says place order for $5,000 of additional merchandise inventory to be delivered next month. All right. So no cash has exchanged hands. We do not have inventory yet. Because we do not have inventory, we have no chance of selling it. And so we have no chance of setting up an account receivable. Because we don't have inventory, we don't have cost of goods sold, and we don't have wage or rent expense. So we actually don't have to do anything here on C. I'm not going to worry about it. I'm just going to move straight on to D. Pay employee $4,000 for compensation earned during the month. Now normally what we would do here is we would recognize this $4,000 expense as it is incurred under the accrual basis of accounting, and so we would see something like, wages expense for $4,000 and wages payable liability account for $4,000. But that's not what we're doing here. We don't have any liability accounts down here. We have some asset accounts, one revenue account, and some expense accounts, but no liability accounts. So we're just going to play pretend that as the employee earned the money, they were paid immediately. So this is choice D. So let's see here. Wage expense has gone up, and just like cost of goods sold is an expense, and it went up on the left, wages expense is also going to go up on the left. And then let's see here. Now this is number or letter D. So cash is going to go down on the right because it's an asset and it went down. E says pay $7,000 rent for use of premises during the month. So it says pay $7,000. So I'm already up here. I'll just plot that negative $7,000 right there for the cash what went down. And let's see here. Looks like some of our choices got cut off, so I'll just put an E here. And expense, this rent expense is going to go up on the left. And then finally, F says receive full payment from customer in part B. Okay, so that's $7,500. So we received the payment. So cash has gone up by $7,500. And then what went down? Well, this receivable that we had has gone down. Okay. So now what we could do is we could actually reconcile each of these accounts. Now this is going to be a little bit awkward for cash because we were not provided any kind of beginning balance information. So just looking through here, we've got $7,500 on the plus, but then we have to subtract out $9,000, $4,000, and $7,000. So we have what we call an abnormal balance. This is actually going to be a negative amount for cash. Now, if we had $20,000 to start off with, or $30,000 to start off with, something like that, which we probably did, we wouldn't actually end up with a credit balance on cash. But given the information that we have, that's what occurred. Over here on inventory, we would net these two figures and we would come up with a balance of $4,500, which is a normal balance for inventory. Accounts receivable would offset, so we would put a 0 here, and we would do that on the left side because the debit side is the normal balance for accounts receivable. Sales revenue, $7,500. That's a normal balance for revenue. Cost of goods sold is just the $4,500. Wages expense is the $4,000. We only had the one transaction, and then $7,000. We'll just underline these figures right quick. And that is a brief glimpse into what we call T accounts.